I was looking at some numbers this morning, just trying to wrap my head around this sheer size of the financial system. And it's funny, when we talk about the market at a dinner party or on the news, 99% of the time, what are we actually talking about?
The stock markets, the Sensex, the Nifty, the latest IPO that popped 20%. That is where the glamour is.
Exactly. We obsess over equity. But if you actually pull back the curtain and look at the plumbing of the global economy, and certainly the Indian economy, the stock market is basically the little sibling. It's the noisy, attention-seeking kid in the front seat. But the engine, the thing actually driving the car, that is the debt market.
It is massive.
Yeah.
In terms of sheer volume of capital, the debt market dwarfs the equity market. It is the ocean that the rest of the economy swims in. Governments, banks, corporations, they all run on debt.
Which brings us to our mission today. We are doing a deep dive into NESM Series XA, specifically Chapter 9, Investing in Fixed Income Securities. And I have to say, looking at the source material you sent over, this isn't just a casual what is a bond overview. This chapter looks like a beast.
It is a beast, but it's a necessary one. If you're preparing for the NISM certification, Chapter 9 is really the pivot point. It's where we move away from generalities and get into the hard mechanics. We're going to cover everything from the basic legal structure of a bond through the entire ecosystem of risks, and there are way more than people realize, into the hard math of pricing, which terrifies people.
I'm already sweating thinking about the math section. I see formulas for present value and modified duration, and I just want to hide.
We'll make it painless, I promise. We will visualize it so you don't need a whiteboard. And then we have to catalog the entire Indian instrument universe, from the money market desks at big banks to the post office savings schemes your parents probably force you to invest in.
Okay, so the goal here is pretty simple. I'm the student, I've got the text open, I've got the exam coming up. I need to know what matters, what's going to trip me up, and why any of this actually makes sense in the real world. Let's start at the floor. Section 9.1, the debt market and financing structure.
Right. Let's set the foundation.
So the text starts with this fundamental distinction between debt and equity. Why do we even need this distinct market? If a company needs money to build a factory, why don't they just issue more shares and be done with it?
It comes down to two words: ownership versus obligation. Think about it from the company's perspective. If you and I start a business and we need capital, we can bring in a third partner. That's equity. We get the money, but we lose a slice of the pie. We dilute our control.
And we have to listen to their opinions at board meetings.
Exactly. But if we borrow the money, if we issue debt, we are just creating an obligation. I promise to pay you interest, and I promise to give the money back in 10 years. But you don't get to tell me how to run the factory. You don't get a vote. I keep my ownership. You get a fixed return.
So it preserves the existing power structure for the founders.
That's the corporate view. Now, from the investor's view, the person buying the bond, it's about safety. Equity is a residual claim. You only get paid after everyone else is satisfied. Debt is a primary obligation. If the company goes bust, the bondholders are standing at the front of the line and the shareholders are at the back.
Although the source text drops a little reality check here regarding the Indian context. It mentions that while debt is theoretically safer,
recovering your money in a default scenario in India can be a nightmare. It's a lengthy, drawn-out legal process. So while you have a legal right to the assets, exercising that right isn't exactly a quick trip to the ATM.
which implies that in the Indian market, trust and the issuer's history are almost more important than the legal contract itself.
100%. The market relies heavily on reputation because the legal backstop is slow. Now, when we look at who is actually doing this borrowing in India, the text splits it into three big buckets.
Right. I see the segments here. We have the government, the PSUs, and the private sector.
And the hierarchy is important. The government of India is the 800-pound gorilla. They issue GSECs, T-bills, state development loans. This is the benchmark. It's the risk-free rate. Then you have the public sector undertakings, PSUs, and banks quasi-government, very safe. And finally, the corporate bond market, which is where private companies borrow.
And why does the text argue that this market is so critical for the economy? I mean, beyond just companies needing cash.
Think about infrastructure. Seriously, if you want to build a highway from Delhi to Mumbai, that project takes 5 years to build and 20 years to pay for itself. You cannot finance that with a bank overdraft or a credit card. You need patient capital. You need a market where pension funds and insurers can park money for 20 years. That is what a developed debt market does. It channels long-term savings into long-term assets.
Okay, that sets the stage. Now let's get into the machinery. Section 9.2, the bond market ecosystem. If I strip away all the jargon, what exactly is a fixed income security?
At its core, it's just two promises wrapped in a legal contract. Promise number one, the coupon. I will pay you a fixed amount of interest periodically. Promise number two, the maturity. On a specific date, I will give you your principal back. That's it.
Let's double-click on coupon. It's a weird word. Why don't we just call it interest?
It's tradition, really.
Yeah.
Back in the day, bonds were physical paper certificates with literal tear-off coupons at the bottom. You'd clip one off with scissors, walk into a bank, and trade it for cash. Today, it's all electronic, but the name stuck. In India, the standard is a semi-annual coupon. You get paid twice a year.
But I see an exception here that the exam seems to love. The zero coupon bond.
The zero. These are fascinating. As the name suggests, they pay absolutely no interest during the life of the bond.
Which sounds like a terrible deal. Why would I give someone money for 10 years if they aren't going to pay me anything until the end?
It sounds bad until you look at the price. You don't buy a zero coupon bond at 100 rupees. You might buy it at, say, 60 rupees. You hold it for 10 years, and at the end, the government gives you 100. Your interest is entirely the difference between what you paid and what you get back. It's built-in capital appreciation.
Got it. So instead of a stream of income, it's a lump sum payoff. Now, speaking of price, the text spends a lot of time explaining the relationship between par value and market price. This feels like one of those concepts that is easy to understand but easy to mess up under pressure.
It is the single most important concept in fixed income. You have to burn this into your brain. The seesaw.
The seesaw.
On one side, you have interest rates or yields. On the other side, you have bond prices. They always move in opposite directions. Always.
Walk me through the logic. Why?
Imagine you own a bond that pays a 5% coupon. That's your ticket. Suddenly, the RBI raises rates, and new bonds are being issued paying 7%. Who wants your lousy 5% bond now?
Nobody. It's trash compared to the new stuff.
Exactly. So if you want to sell it, you have to put it on sale. You have to lower the price below the par value, sell it at a discount until the math works out so that the buyer effectively gets a 7% return.
And if rates fall?
Then your 5% bond is a diamond because new bonds only pay 3%. Everyone wants it. You can sell it at a premium above par value.
Okay. Rates up, price down. Rates down, price up. I'm writing that in big letters. Now, moving through the ecosystem, I see a regulation here that seems oddly specific. The ISIN limit.
Oh, go circle this. This is a classic exam question. Flag this for the exam. An ISIN is the International Securities Identification Number. It's the license plate for a specific bond issue.
And the text says there is a cap on how many a company can have.
Yes. SEBI says a company can have a maximum of 12 ISINs maturing in a single financial year.
Why does SEBI care? Why not let them issue 1,000?
Fragmentation. Imagine if Reliance issued a slightly different bond every single day of the year. You'd have hundreds of tiny little bond issues floating around. Liquidity would be terrible because there would be no depth in any single bond. By capping it at 12, SEBI forces companies to reopen existing issues. It clumps the trading together, making the market deeper and more liquid.
That makes sense. It forces standardization. Now, before we leave the ecosystem, we have to talk about bonds with options. These sound like bonds with a superpower attached.
But they are. And usually, the power is tilted in favor of one party. The two big ones are the call and the put.
Let's start with the call option. This is the issuer's right.
Correct. A call option gives the borrower or the company the right to pay the loan back early.
Why would they want to do that? They went to all the trouble of raising the money.
Think about refinancing your home mortgage. You took a loan at 8%. 2 years later, rates drop to 5%. What do?
I pay off the expensive loan and take a cheap one instantly.
Exactly. That is a call option. When interest rates fall, companies call their expensive bonds, pay the investors back, and issue new debt at the lower rate.
Which is great for them, but as an investor, that sounds annoying. I lose my high interest income just when I want to keep it.
Precisely. That is called call risk. Now, the put option is the reverse. It's the investor's superpower. It gives you the right to sell the bond back to the company at a set price.
And I'd use that if rates go up.
Right. If you're stuck in a 5% bond and rates soar to 9%, you put the bond back to the company, get your cash, and go buy that new 9% instrument. Put options protect the investor, call options protect the issuer.
And then there's the convertible bond. The hybrid.
The hybrid. It starts as a bond paying interest, but you have the option to swap it for equity shares of the company later. It's for investors who want safety but have FOMO, fear of missing out about
Right.
stock price taking off.
Okay, that's the structure. Now let's move to section 9.3. The text lists risks associated with fixed income securities. And there are 10 of them.
10 distinct risks, yes.
I know the tendency is to just say bonds are risky, but for the exam, I feel like I need to know the specific flavor of each risk. So I want to go through these one by one. I'll name it. You explain it.
Let's do it.
Risk number 1, interest rate risk.
We just covered this, the seesaw. The risk that market rates rise, causing the value of your portfolio to drop. This is the big one. If you have to sell before maturity, this risk can eat your capital. It is also known as market risk.
Risk 2, call risk.
The risk that the issuer forces your money back into your hands early. The key here is timing. It always happens when rates are low, which means you have nowhere good to invest that money. You are essentially forced out of a high-paying investment into a low-paying market.
Which leads directly to risk number 3, reinvestment risk.
It is subtle but dangerous. Let's say you buy a bond yielding 8%. You feel good. Every 6 months, you get a coupon payment. But what do you do with that cash? If market rates have fallen to 4%, you have to reinvest that coupon at 4%. Over 10 years, that drags down your total return. You thought you were locking in 8%, but you weren't.
And the text makes a specific point here about zero coupon bonds.
Right. Zero coupon bonds have zero reinvestment risk
Right.
because there are no coupons to reinvest. You lock in the rate for the full duration up front. If you are worried about rates falling in the future, ZCBs are your best friend.
Okay, risk 4, credit risk. But the text breaks this into 3 subtypes.
Yeah, credit risk isn't just they didn't pay. It has nuance. First, downgrade risk. The rating agency cuts the score from AAA to AA. The bond price crashes because it's perceived as riskier. The text uses the ILNFS crisis of 2018 as the prime example here. That was a cascading downgrade event that froze the market.
Subtype 2.
Spread risk. Even if the rating doesn't change, the market might just get fearful of all corporate bonds. The spread, the extra yield over government bonds, widens. When the spread widens, your corporate bond price falls. Even if the government yield is stable, it's essentially guilt by association.
And subtype 3, the obvious one.
Default risk, the worst case scenario. The actual failure to pay. Coupon stops, principal isn't returned. Game over.
Okay, risk 5, liquidity risk.
The fire sale risk. You need cash today. You try to sell your bond, but there are no buyers. Or the only buyer is offering you a terrible price. Government bonds are liquid. Obscure corporate bonds are often illiquid. You might take a 10% loss just to get out.
Risk 6, exchange rate risk.
Only applies if you cross borders. You buy a US dollar bond, the dollar crashes against the rupee. Your returns in rupee terms evaporate.
But wait, the text mentions masala bonds here. How do they fit in?
Masala bonds are a clever workaround. They are issued internationally, but they are denominated in rupees. So if the currency fluctuates, the foreign investor takes the hit, not the Indian company. It shifts the risk away from the issuer.
Clever. Okay, risk 7, inflation risk.
The silent killer. You earn 6% interest, but inflation is 7%. You are getting poorer every year in real terms. You have a negative real rate of return.
Risk 8, volatility risk.
This is a niche one. It specifically hurts bonds with embedded options, like calls and puts. The value of an option depends on volatility. If rates are swinging wildly, the option pricing changes, which drags the bond price around in unpredictable ways.
Number 9, political or legal risk.
So the government changes the rules of the game. Maybe they change the tax treatment of bonds. Or, in extreme cases, they declare a debt moratorium. It's the risk of the referee changing the game mid-match.
And finally, risk number 10, event risk.
The black swan, an unplanned disaster. The text uses COVID-19 as the example. It wasn't an economic cycle. It was an external shock that destroyed the cash flow of perfectly healthy companies like airlines or hotels overnight. Companies that were perfectly solvent suddenly faced a liquidity crisis. That is event risk.
Phew, that is quite the list. But
Yeah.
seeing the distinction between, say, downgrade risk and spread risk is really helpful.
It's crucial. A bond can suffer from spread risk even if the company is doing great, just because the market mood sours.
All right, deep breath. We are entering section 9.4, the pricing of a bond, the math section.
Don't panic. Visualize a timeline.
I'm visualizing.
A bond is just a stream of cash flows. You have little trickles of cash, the coupons, and one big bucket of cash at the end, the principal. The fair price of a bond is simply the present value, PV, of all those future piles of money added together.
And present value just means discounting the future money back to today, because money today is worth more than money tomorrow.
Exactly. We use something called a discount factor. The formula is 1 divided by 1 plus r to the power of n, but you don't need to memorize the formula. Just get the concept. Let's look at the example in the text. You have a 5-year bond. It pays a 10% coupon. But the market yield, so what the market expects, is only 8%.
Okay, so my bonds is better than the market.
Exactly. Because the bond pays 10% and the market only wants 8%, common sense tells us this bond is valuable. It should trade at a premium.
Above its face value,
Yep.
above 100.
Right. So what we do is we take each 10 rupee coupon and we discount it. Your 1's 10 rupees is worth about 9 rupees 25 paisa today. Your 5's 10 rupees is worth significantly less, only about 6 rupees 80 paisa today, because you have to wait 5 whole years for it. And then we take the final 100 rupees principal and discount that too. When you sum them all up, you get 107.98. That is the fair price.
So if I see that bond trading at 102, I should buy it immediately.
In theory, yes, it's undervalued.
Now, in the exam or in an office, nobody's doing this with a pen and paper.
No. You use Excel. The function is price. But you need to know the inputs. You need settlement date, maturity date, rate, that's the coupon, yield, market rate, redemption value, frequency, usually 2 for semi-annual, and basis.
That sounds like a trap.
It is. That leads us right into section 9.5. Traditional yield measures. The basis refers to how we count days in a year. Box 9.1 in your text is a massive exam flag. I mean, circle it, highlight it. For Indian bonds, so government or corporate, we use the 3360 convention. We pretend every month has 30 days and the year has 360 days. It just simplifies the math.
Even February.
Even February, it has 30 days in bond math. However, for the money market, things like T-bills, we use actual 365. We count the exact number of days and divide by 365.
So if I mix those up, my price calculation will be wrong.
And you will fail the question. Simple as that. 3360 for bonds. Actual 365 for money market. Memorize that.
Okay, let's talk about the yield measures themselves. The text mentions current yield versus yield to maturity, YTM.
Current yield is the lazy metric. It's just coupon divided by price. It tells you your income return right now, but it's incomplete.
Why incomplete?
It ignores any capital gain or loss at maturity, and it completely ignores the time value of money, which is why we use YTM. YTM is the gold standard. It's the internal rate of return, or IRR. It accounts for everything.
Yeah.
The interest, the price you paid, the time value, and the capital gain or loss at the end.
But YTM has a hidden assumption, doesn't it? A big one.
It does, a very big one. YTM assumes that you can reinvest every single coupon at that same YTM rate. If you buy a bond with a 10% YTM, the math assumes you are taking your coupon checks and immediately finding another 10% investment for them. If you spend the money on dinner, or if rates drop and you can only reinvest at 5%, your actual realized return will be lower than the YTM.
That's a huge caveat that nobody usually mentions.
It's the difference between promised yield and realized yield.
There are two other yields mentioned quickly, effective yield and yield to call put.
Effective yield is just the annualized rate when compounding happens more than once a year. It's just a slightly more accurate number. Yield to call is critical. It calculates the return assuming the bond is called away at the first possible date. If a bond is trading at a huge premium, you should look at yield to call, not YTM, because the issuer is very likely to refinance.
Got it. Moving on to section 9.6, the concept of yield curve. I love this part because it visualizes the economy. X-axis is time, Y-axis is yield.
Correct. And usually this curve slopes upward.
The normal yield curve.
Yes, makes sense. If you lock your money away for 20 years, you are taking more risk than for 2 years. So you demand a higher yield, short rates low, long rates high.
But sometimes the curve flips, the inverted yield curve.
The spooky curve. This is when short-term rates are higher than long-term rates. This usually happens when the central bank is hiking rates aggressively to fight inflation. The market looks at those high rates and says, this is going to cause a recession. Rates will have to fall in the future. So long-term yields drop. Historically, an inverted curve is a very strong predictor of a recession. Then we have the flat curve, which sounds boring. It is. Yields are basically the same whether you lend for 2 years or 20 years. This usually happens during a transition period. The market is just confused.
And finally, the humped curve.
Like a camel. Rates rise for the medium term, say 5 years, but then fall for the long term. It suggests some specific uncertainty about the medium term future.
All right, section 9.7, the most misunderstood concept in finance, duration.
Macaulay duration. People think it's just time, but it's actually sensitivity. The technical definition is the weighted average time required to recover your initial investment.
Measured in years.
Yes. Think of it as the payback period. Rule number 1. The duration of a zero-coupon bond is exactly equal to its maturity. A 10-year ZCB has a duration of 10.
Because there are no cash flows in between to speed up the payback.
Exactly. Rule number 2. For a coupon-paying bond, the duration is always less than its maturity. Because you are getting cash back early from the coupons, your average payback time is faster.
Now, why do we care about duration?
Because it is a measure of sensitivity. This is the key takeaway. Higher duration means higher interest rate risk. A bond with a duration of 10 years will crash much harder when rates rise than a bond with a duration of 2 years. Imagine a seesaw. A longer seesaw moves much more at the ends than a short one. Duration is the length of the seesaw.
And that leads to modified duration.
Modified duration converts that year's number into a useful percentage. It tells you, if yields change by 1%, the price of this bond will change by X%.
The formula logic is Macaulay duration divided by something like 1 plus yield frequency.
Correct. You don't need to do the math, just know what it represents. So if the modified duration is 5 and yields go up by 1%, the bond price drops by 5%. It's a quick mental calculator for risk.
And there's one final refinement, convexity.
Convexity basically says modified duration is a good approximation, but it's not perfect. The relationship between price and yield isn't a straight line, it's a curved line. Modified duration assumes it's straight. Convexity measures the curvature to give you a more precise price prediction, especially for large moves in interest rates. It's the fine-tuning knob.
Okay, we've survived the theory. Sections 9.8 through 9.11 are the product catalog. We need to run through these rapidly, highlighting the exam traps. Section 9.8, Introduction to Money Market.
Right. The money market is for short-term funds, overnight up to 1 year. This is wholesale banking.
There is a table here with specific instruments. I want to run through them. I want you to highlight the exam flags, specifically the limits and who plays.
Let's go. First, call money. This is overnight, unsecured borrowing, participants, primarily banks and primary dealers. Exam flag. Minimum amount is 1 lakh.
Next up, notice money.
Same as call money, but the tenure is 2 to 14 days. Still 1 lakh minimum.
Per money.
Tenure is 15 days up to 1 year, also unsecured.
Now, market repo and T or PS, these are different.
Yes, these are secured borrowing. You provide GSECs as collateral to borrow cash. Repo is bilateral, just between 2 parties. TREPS, which is tri-party repo, involves a middleman, the CCIL, Clearing Corporation of India. This allows for anonymous trading. Exam flag. TPS minimum lot size is 5 lakhs.
Okay, then we have commercial paper, CP.
Short-term unsecured debt issued by corporates. To issue a CP, a company generally needs a high credit rating. Exam flag.
Yeah.
Minimum amount is 5 lakhs.
Okay, so 5 lakhs for CP and TF, yeah.
Yes. Note that difference. Call money is 1 lakh, CP is 5 lakhs. That is a common mix-up.
And last one in this section, certificate of deposit, CD.
Issued by banks to raise funds. Exam flag. Minimum amount is 1 lakh. So back to 1 lakh.
Okay, that's the short end. Now, section 9.9, government debt market. The big leagues.
The government of India is the largest borrower. The RBI acts as their merchant banker managing the issues. Primary dealers, or PDs, are the market makers who underwrite these issues.
Let's break down the menu of government instruments. What's first?
Start with Treasury bills, T-bills. These are short-term, the shortest, 10 years, 91 days, 182 days, 364 days. Flag those numbers. Pricing. Issued at a discount, redeemed at par. Just like a zero-coupon instrument.
What if the government needs money for less than 91 days, a real short-term crunch?
Then they issue cash management bills, CMBs. These are for temporary cash flow mismatches.
Moving to the long term, dated GSECs.
These carry a coupon and interest rate and have tenures up to 50 years. They are the benchmark for the entire economy.
Then we have some special flavors. Capital index bonds, CIBs, versus inflation index bonds. What's the difference?
Subtle, but important. In capital indexed bonds, only the principal amount is protected against inflation. In inflation indexed bonds, IIBs, both the principal and the coupon are linked to inflation. IIBs provide better protection, but historically, neither has been a massive hit with retail investors in India.
Okay, STREPS. Separate trading of registered interest and principal of securities.
That's
a mouthful.
Imagine a 10-year bond as a chicken. Strips is the process of cutting it up. You rip off each coupon payment and sell it as a separate zero-coupon bond. Then you sell the final principal payment as another zero-coupon bond. You strip the bond into many separate instruments. This creates a range of zero-coupon instruments for the market.
Sovereign gold bonds,
Yeah.
SGB. These are very popular lately.
Extremely. They are denominated in grams of gold, exam flag. They pay a fixed interest of 2.5% per annum on the initial investment, plus you get the capital appreciation of gold prices. It's a way to own gold without holding physical metal.
And finally, state development loans, SDLs.
These are bonds issued by state governments, not the center. They typically pay a slightly higher yield than central GSECs to attract investors, but are still considered sovereign risk. Very safe.
All right. Section 9.1, corporate debt market. We mentioned earlier that this is smaller than the GSEC market.
It is. And it's dominated by institutional investors.
The text mentions debenture trustees. Who are they? What do they do?
They are mandatory for any public issue of corporate bonds. Flag this. They are appointed before the issue. Their job is to protect the interests of the bondholders. If the company defaults, the debenture trustee seizes the collateral and enforces the claim. They are the watchdog.
And who are the main buyers? QIBs.
Qualified institutional buyers, banks, mutual funds, insurance companies, they dominate the volume.
But what about us regular folks? How does the text define a retail individual investor in this context?
Exam flag. A retail investor is defined as someone investing less than euro lakhs in an issue.
There are two specific corporate instruments mentioned here: company deposits and infrastructure bonds.
Company deposits are basically unsecured fixed deposits with companies. They are risky. They are regulated by the Companies Act. You are essentially lending money to a company without collateral. Infrastructure bonds are long tenor bonds, think 10, 20 years, issued by companies building roads, power plants, etc. The government often gives them special tax benefits to encourage people to invest in them.
All right, we are in the home stretch, section 9.011. Small savings instruments. This the stuff my dad is always telling me to buy.
And for good reason. These are the safety nets of the Indian saver. They are generally backed by the government.
Let's rapid fire these. Egg fixed deposits, FDs.
The classic, the go-to, exam flag. The 5-year tax-saving FD gives you a benefit under Section 80C, but it has a strict lock-in. You cannot touch that money for 5 years. Also flag, DIC-GC ensures your bank deposits up to 5 lakhs per bank. That's a key number.
Floating rate savings bonds, RBI.
These replace the old RBI bonds. The rate is floating. It resets every 6 months. Specifically, it is linked to the NSC rate plus 0.35%. Lock-in, 7 years. Tax status, fully taxable, no tax benefit.
Now, the post office alphabet soup. PPF, Public Provident Fund.
The superstar, tenure, 15 years. Tax status, EEE. That's exempt, exempt, exempt. Investment is tax-free, interest is tax-free, maturity is tax-free. Limits, minimum 500 rupees, maximum 1.5 lakh per year.
NSC, National Savings Certificate.
Tenure, 5 years. Tax status. It qualifies for ADC. And it has an interesting quirk. The interest you earn is deemed to be reinvested, so that interest also qualifies for ADC tax deduction in the first 4 years.
SCSS, Senior Citizens Savings Scheme.
Eligibility, age 60 and above. Or 55 if you took voluntary retirement. Feature, quarterly interest payments. It's designed for income and retirement.
POMIS, Post Office Monthly Income Scheme.
Tenure, 5 years. Feature, pays interest monthly, hence the name. Limits, 9 lakhs for a single account, 15 lakhs for a joint account. These limits were updated recently, so they're important.
KVP, Kisan Vikas Patra.
The money doubling scheme. You invest a lump sum and it doubles after a specific number of months. The number of months changes based on current interest rates.
And the final one, strictly for the girl child. Sukanya Samriddhi account.
A fantastic scheme. Eligibility. For a girl child under age 10, max 2 girls per family. Maturity, up to age 21. Limits, max 1.5 lakh per year, same as PPF. Feature, usually offers the highest interest rate of all the small savings schemes.
Wow. We have covered a massive amount of ground, from the definition of a coupon to the intricacies of modified duration to the limit on a Sukanya Samriddhi account.
It is a lot, but if you step back, the structure is logical. First, what is the instrument? Debt versus equity. Second, what are the risks? That 10-item list. Third, how do we value it? The PV and the yields. And finally, what can I actually buy? The product catalog.
Before we sign off, give me the cheat sheet. I'm walking into the exam hall. What are the 3 things I absolutely cannot forget?
Okay, 3 things. 1, day count conventions. 3, 360 for bonds. Actual 365 for money market. 2, the seesaw. Yields up equals prices down, and vice versa. And 3, the retail definitions. Retail investor is less than 2 lakhs. PPF and Sukanya limit is 1.5 lakhs. CP minimum is 5 lakhs. Those numbers.
Perfect. And here's a final thought for the listener. We talked about duration sensitivity. If you, the listener, believe that inflation is dead and interest rates in India are about to crash down, where should you put your money today based on what we've learned?
If rates fall, prices rise. To maximize that profit, you want the highest sensitivity. You should buy long-term, zero-coupon government bonds. That is the maximum duration play. You will see massive capital gains if you're right.
But if you're wrong and rates rise,
You get crushed. High risk, high reward.
that is the perfect note to end on. Even the boring world of fixed income, there's a way to gamble.
Always.
Thanks for the deep dive. If the math was a blur, rewind to section 9.4. Good luck with the exam.
Happy studying.